$86,420. That is the exact median household income in your zip code, printed in black ink on the tax document sitting on your kitchen table. You sit in a swivel chair under a flickering LED light, staring at the line labeled adjusted gross income. The numbers are higher than they were 5 years ago, but your bank ledger tells a different story. The system knows one thing about you. You are a reliable engine of tax revenue, caught in a carefully designed middle tier of the economy. You do not qualify for government assistance, yet you do not have enough capital to protect your earnings from inflation. Every year, you exchange 2,080 hours of your life for a salary, only to watch the purchasing power of that salary melt away. You are running on a treadmill that accelerates every time you try to step off. Level 1, the tax engine. Your household income sits between $45,000 and $90,000. You earn this money through a W-2 payroll system where taxes are deducted before the money ever touches your bank account. In 2026, a single earner at this level faces a marginal federal tax rate of 22%, plus 6.2% for Social Security and 1.5% for Medicare. If you live in a state like Ohio or Oregon, state and local taxes extract another 4% to 9%. By the time you receive your paycheck, nearly 1/3 of your earned value has evaporated. You spend the remaining balance on rent, food, and basic transport, leaving less than 8% of your gross income for savings. This is where the arithmetic of the middle class begins to break down. You work 40 hours a week to sell your time, but you are taxed on the transaction at the highest rate possible. You buy groceries at the local supermarket, noticing that a carton of large eggs costs $4.29 and a gallon of milk is $3.89. You drive a sedan that requires a $65 fill-up every 9 days. The basic cost of existence consumes your energy before you can even think about investing. You feel the weight of this treadmill, but you cannot find the exit. The wealthy do not sell their time, they buy assets that grow tax-free. You are trading your physical energy for currency that depreciates by 3.2% every year due to monetary expansion. The first rule, earning more money on a W-2 slip does not build wealth, it builds a higher tax obligation. Level 2, the debt illusion. Something changes. Not dramatically. Your salary increases to $125,000, and you move into a suburban home with a 30-year fixed mortgage at 6.8%. Your garage now holds a mid-sized SUV financed at 7.2% interest over 72 months. This is what earning six figures actually feels like. You believe you are getting ahead, but the system has simply expanded your capacity to carry debt. Your increased salary has pushed you into the 24% federal tax bracket, meaning the government takes a larger percentage of every new dollar you earn. Meanwhile, the bank collects $2,100 in interest every month on your mortgage during the first 10 years of the loan. You are working longer hours to service the interest on assets that do not produce cash. Credit card offers arrive in your mailbox 3 times a week, promising 1.5% cashback and premium travel rewards. You carry a balance of $8,400 across 2 cards, paying an average annual percentage rate of 21.4%. The bank rewards you with points while extracting hundreds of dollars in interest fees every billing cycle. You believe you are playing the system, but the system is playing you. Your life becomes a series of monthly payments, structured to keep you working. You pay for the lawn service, the home insurance, and the property taxes, which rise by 4.5% annually. The second rule, consumer debt, is a wealth tax you pay to private corporations for the privilege of appearing wealthy. Level 3, the inflation squeeze. This is the middle class plateau. Your household income climbs to $195,000, placing you in the upper middle class. At this level, you face the compound pressure of childcare costing $1,800 per month and university tuition rising at 5.1% annually. You do not qualify for federal financial aid because your paper income is too high, yet you do not have enough liquid cash to pay these bills outright. You turn to Parent Plus loans at 8.05% interest or home equity lines of credit to bridge the gap. Your income is high enough to disqualify you from tax deductions like the student loan interest deduction, which phases out completely at $185,000 for married couples. The system penalizes your success by removing the safety net of the lower tier while offering none of the tax shelters of the upper tier. You keep $45,000 in a traditional savings account earning 0.05% interest, believing it is safe. In reality, the purchasing power of that cash drops by $1,800 every 12 months. The bank lends your money to commercial developers at 7.5%, pocketing the difference while your savings slowly decay. Your safety net is actually a silent wealth drainer. There is no relationship here. There is a transaction. The third rule, inflation hits the middle class hardest because they own assets that depreciate and buy liabilities they cannot defer. Level 4, the accreditation gap. You reach a household income of $280,000, which feels like the threshold of true financial independence. But you quickly run into a regulatory wall. Under the Securities and Exchange Act of 1933, you must meet the definition of an accredited investor to access high-yield private placements, venture capital, or commercial real estate syndications. This requires an individual income of $200,000 or a joint income of $300,000 for 2 consecutive years, or a net worth exceeding $1 million excluding your primary residence. Because your wealth is tied up in your home equity and a standard 401k plan, you are locked out of these high-return asset classes. You are forced to invest your capital in the public stock market, which historical data shows is subject to high volatility and lower average yields compared to private equity. This is legal. This is normal. The law is designed to protect you, but its practical effect is to keep you away from the most lucrative deals. You are trapped by the golden handcuffs of a corporate salary that paid you $240,000 last year. You want to start a business, but the risk of losing your health insurance and steady cash flow feels too high. You spend your weekends recovering from the stress of a job you do not love, leaving no energy to build an independent asset. Your high income has become the cage that prevents your escape. Your 401k is managed by a mutual fund that charges a 0.85% expense ratio, chipping away at your compound interest over 30 years. You pay fees to a system that restricts your investment options to products they control. The fourth rule, the financial system is built on a regulatory wall that prevents retail capital from participating in high-yield private placements. Level 5, the escaped capitalist. The rules become flexible. Your net worth crosses the $1,500,000 mark, and your household income surpasses $450,000. You no longer rely solely on a salary. Instead, you form a limited liability company to purchase a 12-unit apartment building. By using a 1031 exchange under the Internal Revenue Code, you defer capital gains taxes indefinitely when you sell one property to buy another. You utilize cost segregation studies and accelerated depreciation to write off $80,000 in paper losses against your income, reducing your tax liability to near zero. You borrow against the equity in your real estate portfolio at 5.5% interest to fund your lifestyle, which is not considered taxable income by the Internal Revenue Service. You have transitioned from selling time to managing capital. The fifth rule, true wealth is measured in hours, not dollars, and it is purchased by converting labor income into assets that borrow for free. The machine doesn't ask if you're ready, opening every morning. Somewhere in your city right now, a 28-year-old is sitting in a swivel chair under a flickering LED light, looking at a tax document. Her household income is $86,420. She doesn't know yet what the journey costs. Not in dollars, but in the time she will spend servicing debt and paying W-2 taxes. The machine doesn't ask if you're ready, opening every morning. Whoever shows up consistently, patiently, without flinching, they compound. The balance is $86,420. It always starts there, and it always will.